I'm Regina Heinrich, Director of the Stevens Center for Family Business here at Saginaw Valley State University, and it's my pleasure to welcome you to today's major event, What is Your Family Business Worth? A panel presentation on family business valuation. The Stevens Center is fortunate to have 19 professional firms partnering with us as sponsors. Their financial contributions are invaluable in the center's work of supporting the success of family business through the generations with education, networking, and collaboration. But just as important is the time and expertise that representatives from these firms contribute to the operations and governance of the center. Today, 5 of them will share their in-depth knowledge of business valuation, especially as it pertains to family enterprise. We'll bring them to the stage in just a moment. But before we get to that, we've got a few preliminaries. A special welcome this morning to Dr. Jyoti Ghosh, Dean of the Scott L. Carmona College of Business here at Saginaw Valley State University. Welcome, Jyoti. A special welcome also to Dr. Isabella Samanska, Associate Professor of Management, and students from her Family Business Management class. Welcome, we're glad you're here. And let's give those young scholars an applause. As you're aware, the Stevens Center is a membership organization. Currently, some 90 family-owned companies from throughout the Great Lakes Bay region and eastern Michigan are member firms who enjoy a package of benefits ranging from major events like today's panel presentation to peer group sessions, quarterly newsletters, individualized services upon request, and many more. The center has recently launched a new service and benefit, a monthly podcast series featuring family business owners and leaders telling the unique stories of their family enterprises. I'd like to bring to the stage Casey Stevens, Membership Coordinator for the Scfb, who will tell us more about the podcast series and how it can be of value to you. Please welcome Casey.
Good morning, and thank you, Regina. I'm happy to highlight the Center's new podcast series that features interviews with Stevens Center members about family business fundamentals and the unique lessons they've learned as they've nurtured their enterprise and integrated family members into the business over the years. The podcast interviews feature the following family business owners: Kathy Fuse-Holbom of Space Inc., Terry Duperrin Corporation, and Tyler Cluck Nursery. Additionally, we have a podcast interview that highlights the benefits of membership with the Stevens Center for Family Business that you can share with your family business friends to introduce them to the center. Coming soon will be interviews with additional Stevens Center members, including John Shelton, Zender's Restaurant and Snowfest, Wayne Bronner, Bronner's Christmas Wonderland, Beth Teamy, Amigo Mobility International, just to name a few. The podcast interviews allow us to engage and connect the SCFB network through personal stories about the realities of family business ownership and leadership, the trials and tribulations, as well as the deep gratification of establishing an entrepreneurial legacy. The Stevens Center podcast series is produced in partnership with Cliff Devenmois, host of the Call of Leadership podcast and founder of Motion Splash Solutions, Inc. Cliff, if you could please stand. For all of the hard work and expertise that Cliff has put into the interviews, please let's give him a nice warm round of applause. Thank you. Now I'd like to call your attention to a special card that you have on your tables in front of you with a QR code, that little square box. If you take out your cell phones, that camera function on there, when you hover it over this QR code, will allow you to scan and connect with the podcast right directly on your phone, and you can listen to the podcast straight from our website, the Stevens Center website. So you can listen to each episode directly from there. If you have any questions regarding the podcast, please feel free to contact me, and I'll help you access the podcast personally. My email address is cmsteve2@svsu.edu, and my phone number is 989-964-2776. My business cards are over on the Stevens Center resource table. You can pick up a business card and give me a shout that way so that we can connect and help you access that podcast. So thank you very much, and feel free to contact me with any questions.
Thank you very much, Casey. And if you haven't yet, I do hope you'll make it a point to listen to the podcasts. They are inspiring stories of how entrepreneurs have taken the leap and launched a company, frequently confronting all kinds of challenges, but persisting, adapting, and prevailing to grow an enterprise that is a great source of pride to their families, as well as a significant asset to their communities. It's now my pleasure to bring to the podium John Gardy, second-generation president and CEO of Gardy Financial Advisors. John is the current chair of the Stevens Center for Family Business Executive Council. Please welcome John Gardy.
Thank you, Regina. Good morning, everyone. It's a pleasure to be part of the center, and I want to personally welcome everyone here this morning. As Regina mentioned earlier, the sponsors of the center play an integral part not only in financial sustainability, but in actively participating in the work of the center. As I say the name of your company, would representatives please stand to be recognized? And please, let's hold the applause to the end. First State Bank, AKT Peerless, Brown Kendrick, Fifth Third Bank, Frankenmuth Credit Union, Dan Hanley and Associates, Dale Carnegie Training, the Huntington Bank, Independent Bank, the Pendleton Baumgartner Group, Morgan Stanley, Phimation Strategy Group, Plant and Moran LLC, PNC Bank, Pozark, Dyer, Conar, Sefsky, Thompson PLC, Raymond, Saginaw Bay Underwriters, TriStar Trust, Warner Norcross and Judd, Weinlander Fitzhugh, and Yo. Deep thanks to you all for your commitment to the center, to the success of family businesses. Since we gathered here in September, 2 family businesses have become members of the center. It's my pleasure to announce these new member firms and welcome them. Congratulations on your desire and willingness to not only work in your business, but on your business. Our newest members are Czech Corporation. Czech Corporation installs and services industrial scales, including smart, connected, and automation projects, and strives to be the top industrial metrology company since their first service call in 1936. Highland Timber Framing. Highland Timber Framing is a family company based in Southeast Michigan with a passion for building things like they used to be, bringing the beauty of timber framing to people's homes and businesses. Timber framing is ideal for a wide range of spaces such as family rooms and great rooms, to porches and backyard gathering places, to barns for recreation, agricultural, and much more. Again, welcome as you engage with the center. We know you'll find great benefit with your membership. It's also my pleasure to welcome owners and leaders from several family businesses who are our guests here this morning. We hope you'll soon join our member roster and partake in the learning and networking opportunities that are tailored especially for the unique aspects of family-owned businesses. Please give a warm welcome to Bay City Boat Lines, Blue Lakes Charter and Tours, Detroit Dismantling Services, Goem Insurance Restoration, Kenny Produce, McNally Nimmergood Company, MichiganMade.com, Nightlife Entertainment, Paxton Oil, Saginaw Medical Service, Access Mobility Center, Access Construction and Design. We're very happy you're here today with us and look forward to becoming members of the Stevens Center for Family Business. Now I'm going to go off subject a little bit. Regina, would you step up here? Casey, would you step up here? Andrea Henning, would you step up here? And Ethan Gilder, they might still be out there. Would you have them step here for real quick? Oh, come on up here. What I wanted to do is I wanted to introduce the whole team of the Stevens Center for Family Business. It's a small group, but very dedicated. This is the heart and soul of the center, and I don't think they get enough recognition for what they do. So hopefully I'm not in too much trouble, Regina, but I wanted this, everybody give them a round of applause. There is a lot of work in setting up, organizing these events, and so thank you.
Very much appreciate it, John.
Thank you.
We're happy to do it. Thank you.
And now for the main event. Could I please ask our panelists to come up to the stage? They are John Haig, Managing Principal of the Midland Office of Yo and Yo, who will serve as a moderator, along with Todd Gregory, Executive Vice President and Chief Lending Officer of First State Bank, Mike Hinesco, CPA and partner with Weinlander Fitzhugh, Dan Coppola, Business Valuations Consultant with Plant and Moran, and John Lauterbach, Executive Partner with Warner, Norcross, and Judd. And now we're going to find out how we can find out what your business is worth. Take it away, John.
Thank you very much, John. You didn't get us too far behind. I have on my notes, Regina said I'll start at 8:07, and it's 8:07 right now. So we're on target. I will echo the comments that that team was amazing to work with to put this all together. This has been over 2 years in the making, and it's not because we're difficult to deal with. It's because there was a pandemic. So we had to cancel this 2 times, but we're all very excited that you guys kept the faith and we're able to get this together. So we want to keep on schedule here. And so first of all, we're going to start with some introductions. We're just going to do self-introductions, and then I'll go over kind of how the program's going to work. So go ahead. Let's just go down the line.
I'm first on the list here, and my name is Mike Hinesco. I'm a CPA with the firm of Weinlander Fitzhugh. We have our main office is in Bay City. We have 3 other offices in Clare and Gladwin and up in West Branch, and we have about 48 people in total. Our business is centered mostly in the mid-Michigan area, but we have a reach that goes across the state and outside the state of Michigan. We've been around for over 75 years, and we're a CPA firm that provides traditional accounting and tax services as well as other business advisory services.
Dan Capella, principal in the valuation group at Plant Moran, also a CPA firm. We offer audit, tax, consulting, wealth management, real estate advisory, corporate finance services as well. I spend my time focused on the valuation of privately held businesses, assets and securities, work closely with family-owned businesses to satisfy tax reporting requirements, financial reporting, buy-sell advisory, shareholder planning, kind of anything that businesses seem to run into where what's the value of my company or these assets worth is where I spend the majority of my time.
Good morning, everyone. I'm Todd Gregory, Chief Lending Officer with First State Bank. First State Bank, we are a Saginaw headquartered bank and have branches in Bay, Saginaw, and Midland counties. We are a business bank, so we specialize working with businesses of all sorts and sizes. Have a significant amount of experience on the business lending side, starting with 7 business lenders that I'll probably embarrass them a little bit, but we probably bring about 200 years of experience to the table with regards to that. I've been in banking for approximately a little over 20 years and just celebrated 5 years with First State Bank.
Hi, I'm John Lauterbach with Warner Norcross and Judd. Warner is a business law firm. We have about 230 lawyers in 8 offices throughout Michigan. We work with, I think that family businesses are kind of our stock in trade. When you go back to 1931 when Mr. Warner set up a law practice in Grand Rapids, he worked principally with family-owned businesses, and that's been our mainstay ever since. We're a pretty specialized shop, so there's somebody in the firm that does just about everything. My specialty is litigation, so I'm usually the person none of you want to have to talk to. And if my partners are working with the other professionals on the team, I have a real quiet existence. So that's the perspective that I bring, is dispute resolution, usually when something's gone sideways.
Very good. Thank you. And my name is John Haig. I'm a principal at the Midland office of Yo & Yo. Been there 20 years, and about 19 of those years I spent doing valuation work for family business, privately held business. So that's the expertise I'm bringing to this today. However, not today. Today I am a client. So I am a family business owner. We've decided to walk through kind of a scenario here to present. I know it's fun to sit there and listen to CPAs and attorneys and bankers talk all morning, but we thought, what's a kind of a fun way that we could walk through this? So we kind of brainstormed some ideas, and family business and specifically valuation comes up a lot in what we do. And so we thought about, how does it typically come up? And could we kind of play out a scenario of how a family business owner might engage with professionals like these folks, and to kind of walk through the process of things to consider when doing a valuation and how it gets utilized. So this is the only time I'm going to read verbatim, okay? But I'm going to read the little scenario here just to kind of set us up. So in this scenario, I'm a second-generation business owner. I've been working in the family business from a very young age. I'm starting to get a little apprehensive about the future, transitioning to retirement. I have a very dedicated workforce. I have a few key members of management I really want to take care of, make sure their families are taken care of. I have 3 children who worked in the business on and off over the years. One, very interested, wants to be an owner, always has. Another enjoys working in the business. It's very stable income employment for them, not really interested in ownership. And a third that we never see, doesn't want anything to do with the business. But he's a nice guy. We like him. I want to be fair, and I want to be fair to my kids. So in an ideal world, I would work for maybe 4 or 5 more years, but I would like to start slowing down. At this point, I'm kind of considering 3 different approaches, or avenues, rather. One is, of course, selling to an outside party, in an arm's length transaction. Another would be selling to my oldest, but making sure the rest of my family is taken care of. And then the third would be looking at my key members of management and seeing if maybe they would be interested in buying the company or participating. So I'm starting this like a lot of family business owners do, and that's with a meeting with my CPA, Michael. Michael's my CPA. He's been doing our company's books since I can remember, and I'm hoping that he can kind of help me shed some lights on where I go from here. So Michael, what do? I want to take care of my employees, certainly my family, keep the business going, but I just don't know about transitioning. Where do I start?
Yeah, John, well, thanks for reaching out to me, and I've enjoyed our business relationship over all these years, so I'm glad you gave me a call, because I definitely think I can help walk you through the steps and some of the questions that you might have during this process. But more importantly, I want to thank you for thinking ahead. You talked about retiring maybe in 5 years. Mm-hmm. I'm so glad you didn't call me and say, I want to retire next month. Giving us a little lead time, some time to put together a plan. Mm-hmm. There's a lot of details we'll have to work through, but I think we can do that. And probably one of the first things we might want to consider, John, is getting a business valuation done.
Okay. So what's the purpose of the business valuation? Why do we need it?
Well, we want to start there just to get an idea what the value of the business is. There's a number of reasons why we might want to do that. And so it gives us sort of a starting point on where we can look and determine, what the next steps are. Probably one of the more important things about that, John, is if you think about publicly traded business. You know, we can look up on your phone and see what the market value of the price of their stock is every day. Well, we can't do that with your business. In a privately held business, it doesn't have a readily determined market value. It's something that we have to take a look at once in a while, and especially in unique circumstances like the ideas that you're considering. So we need to have a baseline of where to start.
Gotcha. So I've heard like there's all different kinds of different approaches and methods and so forth. How do you determine, can you explain some of those methods, approaches, and then how would you go about valuing a family business like mine?
Yeah, so first of all, the purpose of the business valuation could be to help determine the market value for the company, and we want to ensure that the transaction can be carried out at a fair price, and that it can be afforded by the buyer, and that it meets IRS regulations potentially. So those are some of the reasons that we would do it, and they define this idea of fair market value as where you have a willing seller and a willing buyer, both with the relevant facts and in being able to come to putting a transaction together, but not being compelled to do under any specific compulsion to do so. So you can see that the determination of the fair market value is important from both the seller and the buyer standpoint. And as you pointed out, yeah, there are a number of methods that can be used, and those methods are sort of dictated by the unique circumstances that you're dealing with. So some of the methods, just to give you an idea, might be the adjusted asset value method. There's the market value method. A very common method in your situation for a privately owned business may be the income approach. With the adjusted asset value method, rather simple, but you're going to be looking at the balance sheet. And you're going to be evaluating the assets and liabilities.
So that's like looking at my equity on my balance sheet?
That's right.
Yeah,
that's right. But a lot of times when you and I are looking at it, we're seeing the book value equity. Book value equity doesn't necessarily reflect the fair market value equity, so we would be evaluating that to determine what's appropriate. If that was the method we thought most reflected the most appropriate value for your business. The market value method is a method that would look to the marketplace. There is databases out there that capture transactions of even private companies that you can analyze to determine, multiple of earnings, income streams, and we may be able to look to those, but it's probably unlikely that we would based on the size of your business and the history of your business. The income approach, as I said, is maybe the most common, but there's a variety of income approaches, and so we would have to drill down and determine whether it's a multiple of straight earnings or a multiple of what they call EBITDA, which is your earnings before interest, depreciation, amortization, those kinds of things, more of a cash flow capitalization. And then that capitalization idea is we would have to drill down and determine what the risk factors your business is associated with, and the higher the risk factors, the higher the capitalization rate, in the multiple then is an inverse of the capitalization rate. So the higher your risk of business issues, the lower the multiple. So we would look at those various methods to try to determine which is the most appropriate method and technique to value your business.
Gotcha. So it sounds like there's quite a few different approaches, and you just kind of have to take a look at the individual company and see which one's applicable. John. But when an evaluation is being performed, do they have to look at every approach and consider that, or?
Generally, yes. Okay. So we may want to consider, looking for someone that has the credentials to do such evaluation, and they would consider all those methods, trying to narrow down which is the most appropriate one in your circumstances. The things that you might want to consider in looking at who would be appropriate to do evaluation. I've been around your company for a long time, and I have some ideas, but it might be better to find somebody that is independent from your organization, and they can come in and do a completely outside look at your company, get to understand your business, and then recommend the most appropriate technique. And so there are people that are in the business that maybe even have valuation credentials. There's the ABV, which is issued by the AICPA, a business organization, the CVA, a certified valuation analyst. So there are people that have certain credentials like that that we could consult with. In fact, I do have somebody I might refer to you, and
Really?
we could engage him, and his name is Dan.
Dan. Oh, really?
And
Well,
Dan
how you
does
doing?
just that.
Before I call Dan, I just got to say,
Sure.
I went online and I Googled some business valuation. And I see there's like online companies that can do this for you, and it's like
Yeah, great.
$1,500. Would they be able to do something?
Great question. In today's world with technology and easy access to things like that, it's not always the most appropriate way to go. Okay. The lowest cost isn't always the most appropriate way to go. That's why referring you to somebody like Dan that has the credentials is probably a better idea, because you're going to get quality, you're going to get objectivity, and independent evaluation.
Well, I mean, it is probably my biggest asset,
That's correct.
Is this stock, so I should probably be willing to spend a little to make sure it's done right. So, okay, great,
right.
thanks.
Thanks,
Dan.
John.
All right. Dan, how you
Hi,
doing?
John.
Nice to meet you.
Nice to meet you.
So
as well.
my CPA suggested I get a business valuation. Let's start the process. What information do you need from me?
Sure. So that process starts with a conversation usually. We like to understand your business, what keeps you up at night, how your business operates, and then we'll provide a pretty standard information request list. This will ask for items such as tax returns, recent financial statements, governing documents, any budgets or projections, expense detail, really kind of that information that will help us better understand your business, how it operates, what really drives cash flow. We'll look at tangible assets as well. So it's not meant to be too burdensome. We're not trying to create a bunch of work for you, but we need to get enough information for us to really understand those items that are critical to cash flow and understanding the risks of achieving cash flow.
Gotcha. So after I provide the information, there'll be some discussions, some management interviews, maybe that?
Yep. We'll want to talk through with ownership, with key management to understand customer relationships, what intangible assets might exist out there that might not jump off the balance sheet at us, and really, again, kind of hone in on what's happened in the past, transition that story to, all right, how does that lead to future expected earnings?
Gotcha. So my initial reaction is I'm gonna provide you these financial statements, and Dan, I got to share some with you. I don't like paying tax, so my financial statements. If you look at my income statements, I mean I make a lot of money, but my financial statements might, there's some tax planning that's going involved there. How is a family-owned business valuation maybe a little different than a public company valuation?
Yep. No, that's a great question, and something that we run into all the time. We love working with family-owned businesses, and when you compare that to a public company or private equity-owned, public and private equity are really driven by satisfying the needs of their investors, right? They're trying to maximize investor value. Family-owned businesses are designed and run to achieve the objectives of the family. So if that's tax mitigation, that's questions that we'll dive into and want to understand how that structuring works and really understand what the expected cash flow can be. If it's, keeping Uncle Joe employed, and though he might not be contributing much to the value of the business, but that's important for the family to keep those members involved, we'll understand that as well. And really that dovetails into the purpose of the valuation, what perspective we're going to be taking on looking at what the specific subject interest is and how we're going to understand that projected cash flow. Is it going to be business as usual, or are we going to be looking to try to capture all those items, add them back, and really identify what cash flow would be to an outside investor coming in that's looking to maximize cash flow? Or is it a situation where you might be talking about a fractional minority interest that doesn't have the ability to change those items the way the business is run? And are we going to project cash flow in that business as usual setting? Because that can result in two very different values. Yeah,
well, I'm glad you said that, because that's kind of my next question is looking at the potential buyer. I mean, if I want to sell to my family, I'm going to tend to, give them a little bit of a deal, and make sure something that they can afford. But I also have heard that, one of my competitors is might be interested in the business too. So, how do you, is there something like a different standards of value that you would utilize, or?
Yeah, so that would get into, what is the specific interest that we're looking at, right? So buying a 10% interest in a family-owned business is very different than buying 100% of the business, right? Mm-hmm. You buy 100%, you can step in and make any changes that you want, right? You put the board of directors in place whose main objective is to drive shareholder value. And so it can operate the business the way that it sees fit. Or if you're looking at that 10% interest, it's going to be who controls that entity and what are their objectives? How are they structuring compensation? Are they running any personal expenses through the business? Are they maybe having some non-operating assets, such as the condo that's near a critical customer that might not be as critical these days, but you still like the condo and it's in the business, or the company plane that doesn't seem to be used as much as...
You seem to know a lot about my business.
And so when you look at those different, it's almost a question of value to who or whom. When you're looking at that 10% to a family member, hey, it's business as usual, you can achieve that discount that you might be looking for by saying cash flow is going to be what you want it to be. If you're looking at selling to private equity, we can help you understand how they're going to view your business through a leverage buyout model or making some of those control adjustments. And then even a value to a strategic. So that'd be somebody within your industry that might already have some of the infrastructure expenses that you're currently incurring in place where they don't necessarily need the back office. They might see value in your technology or the way that you do things that they can plug into their customer base, that they don't have that IP that has synergistic value to them. Mm-hmm. And so it can be worth more to a strategic than it would to a financial buyer such as private equity.
Gotcha. So speaking about like being valued more, I was talking with my CPA, and he mentioned one of the methods is you look at the assets and you subtract the debt, and that's one method. But I keep hearing about blue sky value or intangible value. What does that mean?
Sure. So I think what that tries to capture is really that premium above your book value. So the balance sheet is a great starting point for any valuation exercise, and the book value of your equity is a useful data point, but it really is more of a reflection of accounting and decisions that you've made on distributions and things like that, right? It doesn't capture the investment that you've made in those intangible assets that you had mentioned and the goodwill value of the business. So an example would be the customer relationships. You might have those long-standing relationships that generate cash flow that aren't going to show up on your balance sheet. You might have branding, that strong trade name that everybody knows that they want to associate with, the Coca-Colas, the Kleenexes, that type in any given industry, that long-standing reputation. Your workforce, I think, especially in this environment, right, that strong workforce, work and talent is a hurdle for a lot of companies these days. And so having that team in place is really an asset that is not going to show up on any financial statement, but certainly would have tremendous value to a potential buyer.
That's great. Yeah, I've heard of that workplace and force in place. I mean, because we spend a lot of money to get talent, and that is a real asset. So your methods of valuation would identify value associated with those intangibles, or
yep. Okay. And usually that's a product of either a market multiple or looking at those earnings going forward and say, all right, based on assessing the amount of cash flow, the timing of cash flow, the risk of cash flow, do you end up with an enterprise value that exceeds the tangible assets on your balance sheet? That gets you to your blue sky, your goodwill amount that captures the intangible assets of the business.
Gotcha. Okay. Very good. Well, our business is doing okay, but the last 2 years have been rather rough with pandemic, and as a part of that, we were able to qualify for some of the incentives like the ERC and the PPP and so forth. How do you account for that in the valuation? Yeah,
and I think the last 2 years probably extend beyond the programs that create noise in the financial statements. It's really what does a normalized earnings level look like going forward. There's been a ton of change in a lot of different industries and a lot of challenges that businesses have fought through. So items like the employee retention credit, the PPP loans, no buyer is going to be willing to pay a multiple of those dollar amounts, those earnings. It's non-recurring, right? So you're not going to get another PPP loan that's going to get forgiven. So that would be excluded from any cash flow analysis, those types of items. What a prudent investor would do is really look at, okay, here's the last couple of years and the noise that's happened. How did the business change? What is the business going to look like going forward? So what is future cash flow? And through some of those challenging times, how did the business get smarter? What investments were made? What does the next couple of years look like? And really try to understand future cash flow. So if you look at a trailing 12-month EBITDA number, it might be low. Well, it doesn't make sense to pay a multiple of that trailing 12-month EBITDA number if it doesn't reflect the value of the business.
Gotcha. So is that that's what they mean when they say like normalizing the income statement and balance sheet? It's
Normalizing
like
captures a lot of different things.
Yeah. Okay.
But yeah, that's one of the items.
One of the terms.
Yeah.
Okay.
Yeah.
I just heard that in my Google research, so I just. So you know, I'm
thinking the normalized EBITDA.
There you go. I've also heard that you can gift stock too, because I don't know if my family's going to be able to afford it all. So how does a valuation account for that? Is that a different type of valuation, or I've also heard about some ways to like discount the values?
Yeah, and that kind of gets back to your three options that you were looking at, whether it's selling to an outside party or within the family or looking at management. So gifting is an effective estate planning strategy that you can talk through with the financial advisors and understanding the whole picture of the estate. But what the gift side of transitioning ownership in the business can do is allow you to take discounts on that 10% interest, right? So that fractional, non-controlling, non-marketable interest. Nobody wants to buy 10% of a privately held business. It's not an asset people want to buy control. They want to be able to have those elements of control. So when we perform our assessment of value, we'll come up with the value of equity, and then from that point, we can look at discounts for lack of marketability and discounts for lack of control in certain situations that allow you to further reduce the value of the equity that's getting transferred to the next generation. And so what that allows you to do is to, within your estate plan, use your lifetime exclusion amount, and not getting too deep into any IRS code here, but to really move ownership of that privately held business more effectively at lower values to the next generation without any of those recipients having to come up with cash to pay you for it.
Gotcha. So that sounds something like I could work with you and Mike on in terms of doing that.
Financial advisors.
Well, this sounds great. It sounds like you know what you're doing. Can you give me an idea of like what the cost for evaluation is, typical turnaround?
Sure.
I'm seeing $1,500 online, so it's probably a little.
Our favorite answer in valuation is it depends. And it depends on a lot of things, right? So the complexity of your organization, how clean are your financials, how clean is your budgeting process. We base our fees off of an estimate that we can usually pull together just by having a couple high-level documents, whether it's tax returns or some financial statements. And our fees are based on the time that we're expecting to incur. So we'll provide an estimate, but it really does depend because there's things like real estate appraisals, machinery and equipment appraisals, how many different entities we're going to look at that can all really complicate the picture very quickly.
Gotcha. All right. Very good. So once we determine the value, how do we structure the actual transaction? We figure out what it's worth, and if my family's going to purchase the business, they don't have the money to do that. How do we go about that?
Yeah. So putting the outside buyer aside, right? Because financing it and structuring is their problem. If you're looking at either between management or within the family, I think getting out ahead of some of those questions on how it fits in your overall estate and the mechanics of structuring that transaction, how it's going to get financed, is a great question to start to think about as you're starting to understand that value, and if it makes sense to pull in any of the banking relationships that you have and say, okay, we're looking at this recapitalization and we're trying to get an understanding of how we can finance it. It would be really kind of leveraging some of those relationships in the banking industry.
Do you have any ideas of any suggestions who I should go talk to?
One that I would recommend is my friend Todd here. So I'd like to introduce you to John.
Todd, how you doing? Nice to meet you.
John, nice to meet you as well. This is
the
very
most
convenient.
efficient meeting that I've ever had.
If it only just worked this well every time.
Yeah, exactly. Todd, I'm going through the evaluation process. I was advised to ask you, how a bank can help finance a transfer of ownership like this. If I sell to a third party, I'm going to want, that's kind of on them, right? I want cash up front. If I'm selling to my family, I'm more likely to work with them and maybe you on helping to structure the deal. So, how do you typically help family business through succession planning like this using the valuation?
Well, the first thing I'm going to do, similar to Mike's comment, I'm going to applaud you for being out ahead of this. The quicker you can bring in your kind of professional team, the better. And certainly from a perspective of the banking, and I'll elaborate a little bit in terms of why that's important. But John, what will be important is you and I to just start simply with trying to understand what your goals are here and what's the desired outcome that you're looking for. You've got 3 scenarios that you're investigating: selling to a family member, maybe selling to key individuals within the organization, or looking outside to a third party. And I think once we're able to kind of figure out, what your desired outcome is, and maybe look down one path. So let's say path A is selling to your son. Then I think, really it's a matter of sitting down and trying to make that happen. Vetting through what that, all the variables that are considered there. One, do you have a willing buyer in your son? That's going to be an important aspect of it. And then getting into the capacity of the organization moving forward in terms of repayment, the financial ability of the buyer. Are they bringing equity into the plate or to the table? Perhaps you're going to carry some of the equity as the seller.
I probably will.
Possibly. Collateral, what's our collateral look like? We've talked about intangibles and things like that. So looking at all of that. And then the other thing I want to, maybe stop and talk a little bit about is that's all of the kind of the numerical part of it and the financing part. But what's really critical is you've taken this company to this point. But moving forward, we're talking about the potential of new leadership within the organization, new management. And it's going to be the effectiveness of that new leadership and management to continue the success of the company. Then that success leads to the repayment of any debt that may be there. And whether that's the bank debt or a combination of bank debt along with any debt that you might be carrying personally. So there's going to be an aspect of this to get, comfortable as a bank and a confidence in the leadership of the organization moving forward. Understanding that that's been thought through as a team, specifically as a family entering into this. So, and then I think on the backside of that, it's going to be collecting financial information and then certainly looking at the aspect of a likely engagement in a business valuation.
Gotcha. Oh, so that's very helpful. So with a valuation, is that required in financing like this?
So what I would say is every buy-sell type of transaction has its own kind of unique set of characteristics. And so I would never go into it saying that in every transaction like this, it's going to require business valuation. The first thing I would say is kind of the profile of the seller. If we have a seller that is willing to kind of work with the transaction, carrying debt, some other things, then that kind of enters a little bit more creativity into how that transaction is put together. So that'd be the first thing I would say is dependent upon that. And then other things, the size of the transaction, what that collateral pool or access to collateral is going to look like. Dan just talked a little bit about it. Some of the extraordinary events that have happened in the last couple of years has created some noise on financial statements and trying to see through and understand all of that. So all of those things kind of play into as factors. And then the other aspect that I would say that can dictate it is, if going through this process brings us into bringing the SBA involved in the transaction, the SBA has its own set of guidelines. And so if we look to the SBA to shore up the transaction for some reason or another, a lot of times it's along collateral, then anything, I believe it's $250,000 and over, the SBA will require an evaluation be done. So if we bring in the SBA, that is a requirement. Yeah. I would always share this, whether the bank is requiring a valuation to be done or not, I think it is proper and good due diligence on behalf of both the buyer and the seller to engage in that.
Okay. Yeah, of course, we also have the IRS for compliance, right, that weighs in there, but that's good to know about the SBA. So the interest rates are climbing right now. How does that play into the financing and maybe the overall value of the business?
Well, the unfortunate part, rates are going up, and what it does do is increase the cost of a transaction. But I'm going to say it maybe another way is higher rates kind of erode buying power. And so if you're looking at the company overall has the ability to service a certain level of debt based upon EBITDA, free cash flow, different things that contribute to that. And if that, whatever that dollar amount is, that has the ability to service X payment per year. Well, at rates at 4%, that payment may equate to a value of, say, $1 million. But if rates have climbed up to, say, 8%, then that payment now may equate to a value that's only, say, $750,000. So it does erode the buying power there. And now that doesn't mean necessarily that you can't get more money for your business. There are other aspects that may mean more cash into a transaction. Maybe there's a renegotiated, or again, kind of back to the profile of the seller. Maybe you are willing to carry a little bit more debt personally as opposed to the bank carrying that.
Gotcha. Now, I was advised by Michael, my CPA, to have, and my attorney, you might meet him in the future, that to have my entities in two different, like I have a real estate company that owns the building, and then I have an operating company. So how do I need an appraisal for the real estate, and how can you bring that into the transaction somehow?
Oh, you bet. Quite common. From a standpoint of the real estate, kind of depends on the transaction size. We'll always need an evaluation of the real estate. We may be able to accomplish that through what's called an internal market evaluation. It's a little less expensive and can be done a little bit more timely. If we require that we need something more than that on an appraisal, then yes, we're going to go out and get a third-party appraisal on that. And that's an important piece too, because if real estate is involved, it's important to know that the appraisal really should be ordered by the financial institution. Two things there is the banks usually have done some type of already work to establish a list of certified appraisers that they work for or work with. Doesn't necessarily mean that we can't use somebody else, but for you, what we've done is we've done the legwork to say these are certified appraisers. We've looked at their work. We've looked at their resume. You can trust in kind of what they do. And so we narrow that scope down a little bit in terms of who might be best for your organization, and then, or for the real estate. And then secondly, as I mentioned, it's going to be important that the bank engage that, because if we're looking at financing, that appraisal needs to be for the benefit of the bank. And then if there's SBA involved, they also need to name the SBA as part of that as well. If it's done outside of that, then what will have to happen is the bank would need to, or you would need to go back to the appraiser and have them recertify it to them. That's going to cost you additional time, additional money, and that's not always a guarantee that they will do that.
So that's for the real estate. Now, how about because I really like this Dan guy I just met. Is it okay if we use him, or do you have to order that too?
Again, very good to bring the bank into this early. Once again, from a banking perspective, I think you'll find the banks typically have a list of evaluation individuals or organizations that they work with. And so if you bring that in, we have the opportunity to sit down and say, hey, we work with these individuals, organizations, they're very accredited. That's going to be very important because, we're going to look for a detailed report that's going to come from the evaluator. It needs to be by somebody that we know their work. We want them to be certified. It's going to be very important that within there they've given an opinion of value. And then inside of that, we want to see the assumptions, the calculations that they've used. Kind of going back to Dan's comments, there's some noise in balance sheets and income statements these past years. And so that's really critical information for us to be able to see and digest to understand the value that's there for financing against it.
Gotcha. That's good to know because my Google research, I saw that there's like 3 different levels of valuation, like a calculation report or a summary or detail. And it seems like that calculation report is really just a calculation. It's not an appraiser's opinion of value. So you really need to have like the summary or detailed report that
Correct.
That actually
we look for the detailed report.
Okay.
Absolutely.
Okay. Very good. Especially some of those ones online, it looks like they're just calculation reports. So
I'm not familiar with those.
that wouldn't help you. That wouldn't help you sleep good at night. Okay. Very good. So once we determine the value, so we got the value. You got explained some of the ways you can help us. Then how do we kind of go forward? What are the next steps with kind of putting this transaction together?
Yeah, so I think what you should expect from the bank is to get a written set of either terms, or if we've gone far enough in the process, maybe there's a commitment to terms that's there. And so we would provide you kind of what those terms look like for you to review. And certainly if you're not already working with an attorney, highly recommend that you bring an attorney into the kind of activity that you're looking at as another body to kind of look at that, the legal aspect of that. And I know one sitting over here to my left that I think would be... You got a
referral for me?
Yeah, I do. I think he'd do really, really well with that.
This is great. Well, why don't you introduce me to him?
So let me introduce John Lauterbach.
Thanks, Todd. What a coincidence that we all ended up at this meeting again.
John, how you doing? Nice to meet you. It's way over there.
Good to see you, John.
Yeah. I've met with my CPA, a business appraiser, commercial loan officer relating to transitioning my family-owned business to the next generation. I believe that's what we're going to do is try to keep it within the family if we can. I think we're getting to that point where I need to start documenting this transaction and so forth. So, what do you need from me to kind of get started with this?
Sure. Well, first of all, John, like your other professionals assembled here on the team, I want to congratulate you for starting the process early, and I really want to commend you for putting together the right team. Because none of the 4 of us can give you everything that you need as you consider this. Although I got to give a shout out to Dan. He already knows everything he needs to know as a lawyer because the answer is always it depends. That's like the first thing they teach you in law school is it depends. So I think the first thing, John, that we're typically going to talk about is how to structure the deal. What's going to be sold? Are you going to sell your stock in the company, or is the company going to sell its assets to a buyer? If it's an asset sale, as the name suggests, the company is selling its assets, and that's typically free and clear of liabilities. But since the company is selling its assets, the buyer doesn't necessarily get the customer relationships, the brand, the goodwill. So that can be kind of that's a less preferable strategy if the buyer's interested in taking on the enterprise value. Typically, when you're selling to a family member or a management team, you're going to structure it as a stock sale rather than an asset deal. So in a stock sale, the company's going to remain intact. It's still going to control its assets, but it's also still going to have all of its liabilities. But again, usually when you're selling the enterprise as a going concern, that's what your management team or your family members want to carry on. Your kids, for example, John, 2 of your kids have grown up in the business. They've probably had their summer jobs there and have been around the office for their whole lives, and they don't want to buy the assets. They want to buy the enterprise as a going concern. So you need to think through how you're going to structure that stock sale. Are they gonna go see Todd at the bank to get a loan to cash you out, or is it gonna be a blend of cash down payment financed by the bank with you taking transferring your stock over time? And are you gonna have collateral? Are you gonna have a lien on the stock that's being sold? Is the company gonna guarantee any obligations to you? So those are some of the things that we need to start thinking through as we think about how we're gonna structure the deal. And I guess one of the first things that I would again commend you for putting together your team, but think through what are the tax consequences for you as the seller, because that can drive how we structure it, whether it's a stock sale and whether it's over time, and how those gains are going to be treated. Okay. And so forth. So those are some of the initial structuring things I'd start thinking about.
Gotcha. And so I really want to take care of, like I told you, it's three children. So I want to take care of the others who are not involved in the business. How do I do that?
That I think is one of the most complicated pieces of this puzzle, especially where you have non-participant kids. You've got two of your kids that participate in the business, and they seem to work pretty well together. But are they going to be 50-50 owners? Are they going to end up owning an equal share? Are they going to have a buy-sell agreement between themselves? Are they going to be directors? Are you going to stay on the board of directors? Are you going to have other non-family members to help them decide long-term strategy and help make business decisions? And how is the non-participant child going to be affected? Are you planning to transfer any stock to perhaps a minority interest to the non-participant child? And will that non-participant perhaps be on the board of directors? Because one of the really common issues that arises once we transfer to that next generation are things like, will the company pay dividends? Mm-hmm. So that third child that you love just as much as you love the other two that lives out you said out west, right? Yeah. Out of state. If the participant kids want to carry on your great work and continue to build the company and make it even more successful than it's been all these years, they're probably going to want to invest cash back into the business. And you need to think through with your estate plan and other planning devices how that might affect the child that lives out of state and doesn't participate in the business, but is still a shareholder and might want a return on that investment in the form of dividends that your participant kids might not want the company to pay out.
Gotcha. So that valuation would really come into play then in determining if I want to update my estate plan and I'm carving out these assets. If I don't want the kid who's out west raising alpacas in the mountains, we don't want to involve him, but we want to give him plenty of his share. We know what the value of that business, of that asset is.
Exactly. Getting the valuation is really important, and because the alpaca farmer out west is going to have a minority interest. Being able to gift an interest in the company, perhaps over several years at that discounted value that a professional like Dan and Mike can help you figure out is really important. And I think the succession planning has to include both your business strategy, but also your personal estate plan to make sure that those two ideas are wedded to think through the big picture. Gotcha.
So since I've started so far in advance too, I've been complimenting that a few times here. It sounds, and then taking into consideration that there's some discounts, it sounds like, what are your thoughts on maybe transferring ownership over time? Like a percent, could we take advantage of some of those discounts and kind of save some estate taxes maybe?
Sure, absolutely. And that might make a lot of sense in your situation as you're, as you put your blood and sweat into this business for all these years. It serves two purposes. One, it gives the buyer, the two kids who are going to take over the business, a little bit of time, and it gives you some time to see how it's going. If you structure it over the course of several years, it helps the buyer acclimate to the idea of taking over ownership and taking on increasing responsibility for the company's success. But it also, as Dan said, if you're transferring that minority interest, if you transferred a 100% interest, you might not be able to take those discounts. But if you did it, for example, at 10% or 5% at a time, you could transfer it at the discounted value, which may have significant both tax savings for you, but also it'd be advantageous to the kids who are receiving the stock.
Gotcha. I'm also thinking too that because I own the LLC that owns the building, so I might keep that, for a period of time, just kind of transfer the operating company. Does that make sense?
That can make a lot of sense. Yeah, to be the friendly landlord for a few years to see how things go, and sometimes that can be a way to help ease the transition as well, for you to have an incentive to kind of keep an eye on how your tenant's business is going, to make sure that landlord-tenant relationship stays solid.
Sure. So from a transactional standpoint, it sounds like you come in and you're going to put together the documents, a buy-sell agreement. You can help make sure that the estate plan is up to date, maybe update the lease agreement to my LLC.
And all that's available online.
Okay. Sweet. That was my next question.
And it's not $1,500.
Awesome. Well, very good. You mentioned taxes, and I really hadn't thought about them yet. How should taxes be handled, or how will taxes be handled in that situation?
I think that's when you go back to your tax professional again. All four of us have a piece of the puzzle that we can help you solve, but none of us. I think it's really important for our professionals to kind of stay in our lane. Yeah. And so when you have tax questions, I'm going to encourage you to go back to see your tax professional. If you have specific questions about the valuation process or those discounts that we talked about, I'd have you call Dan, and he's going to tell you it depends. Okay. And then of course, go see Todd at the bank.
So it might be a good idea to get everyone together in the room.
Get the team together, just like you're doing.
Is that what you said?
Yep.
Okay.
Get the team back
well, how
together.
about I call a meeting? We'll get everyone together.
That sounds like
sound
a great
good?
idea, John.
All right, we'll get everyone together. So I'd like to thank you for joining me for this meeting. We got all of our professionals here, okay? And also I brought all my family members here. They might have some questions for you too. But before we get started here, I just had a couple little other questions I just wanted to pose to each one of you, and if we can kind of go down the line here, and then I'll see if any of my family members have any questions. Sound good? Yes. Okay. Cool. All right. So Dan. Wait, do I want to talk to Dan first? No, Mike. I want to talk to you, Mike. Okay, we'll go on. Taxes. Talk to me about taxes. I keep hearing about making sure the price is allocated and so forth.
Well, based on the discussion that we've been having here, that if this was structured as a sale of some of your shares to a family member, based on the value that's determined, and I believe you're an S corporation, so yes. For all these years, John, we've been tracking your basis. So once we establish, just like if you bought stock on the stock market, you sell it at fair market value and you compare it to the basis of your stock, and you're going to have a gain, hopefully. And we would do the same thing. We've been tracking the basis in your stock. We're going to look to the fair market, compare it to the fair market value, and you would have a gain on that. Then depending on how you end up financing it, whether it's some seller financed or whether you're cashed out on that, that could determine whether or not the tax is accelerated and paid up front, or whether the tax is paid over a period of time as you collect the payments on the seller finance note. So there's some options there, okay. But I'm pretty sure that the way we're structuring now, there'll be some kind of gain that we'll have to anticipate the tax consequence for.
Okay. So we really need to structure it such that we can reduce taxes.
That's right.
Okay. Well, that's why everyone's here in the room. So, Dan, I have a question for you. Do you have any advice to a family business owner like myself to ways to increase the value?
Yeah, that comes down in the valuation world. It's really kind of three things: amount of cash flow, timing of cash flow, risk of cash flow. So when you're assessing any strategic plan, keeping those three things in mind is really what ultimately results in value. And that can be investing in technology, right? Looking at processes, how can you gain efficiencies? Is it further entrenchment with customers. Where are you going to spend your time? Where are you going to spend your efforts? How does it get back to those three critical areas in valuation? So not having all the details on your business, it would be really kind of focusing on how do you adapt to this ever-changing world. There's always been change. There's change going on now. And make those wise investments when there are some economic headwinds to position yourself to come out on the other side of any recession or whatever is going to happen here in the best position you can for your business. That's what's going to get rewarded in the valuation world.
Gotcha. I wonder, I keep hearing about like key person discounts and stuff. Can you talk to that? Do you know?
Yeah, sure. So when you're thinking of cash flow, and one of the key risks that we look at that can increase discount rates, decrease value, is if you have too much of that, business intangible value tied up in one person. You might have the business owner that holds all the key relationships or the manufacturing know-how on what makes that business tick tied up in one person. So that can be a key business risk that makes future cash flow less valuable because it's tied to one individual. So the better job you can do at diversifying that, the more value your business is going to have.
Gotcha. Yeah, so getting my kids involved and having a really strong management team. That's really
processes in place that are repeatable.
Got it. Good. So I'm pretty sure I know where I'm going to go with this transaction. But Todd, I do keep hearing about this idea of like an ESOP, where the employee. Can you speak to that at all? What is it?
Sure. So an ESOP, what you're essentially doing is you are selling the company or a portion of the company to your employees. Mm-hmm. It is a consideration. I think some common characteristics to consider an ESOP would be that you've got a strong management team currently in place. Probably looking at a company that is fairly mature and pretty consistent in terms of its financial performance. And what I would say, again, from especially if you're considering ESOP, be out ahead of it. It does take quite a bit of time. It does begin with a business valuation to assist with the value of the stock that's there. And so it's going to take time, definitely some expertise, especially from the legal side. And it does have a pretty decent amount of expense attached to it, but certainly something to consider.
Something to consider. Okay. Thank you. And Mike, I have a question for you. So I keep hearing from like people in my trade groups and stuff. They keep saying that, yeah, your company should sell like 5 times EBITDA or something like that. So what do I do with that information? I mean, is that what you will use in your valuation? Or?
Right, and we would talk to Dan and get some his expertise in that. But the basic concept is that a multiple is a reflection of a capitalization rate, which we were talking about before. And so, a multiple of 5 would indicate that there's a capitalization rate of 20%. And so typically what we'll do is we'll start with an analysis of how do you come up with the capitalization rate, and you convert that rate into a multiple. So 1 divided by 20% is a multiple of 5. 1 divided by 25% is only a multiple of 4. 1 divided by 33% is a multiple of 3. So you can see as the capitalization rate goes up, then the multiple goes down. So you would be saying, well, what can we do to drive that capitalization rate down? Okay. And because the lower the capitalization rate, the higher the multiple. Gotcha. And so the capitalization rate is a function of risk. And so typically we would use what's called a build-up approach. You would start analyzing levels of risk related to your business. There are inherent risks related to a privately held small business, maybe based on economic factors that limit your customer base, limit your region, limit your growth capabilities. Well, those things will tend to drive that capitalization rate higher. Okay. And so there's a number of factors that go into the analysis of the the capitalization rate, but the build-up rate will sort of break that out, or the build-up concept will break out these different levels of risk and come up with an appropriate rate to dictate what that capitalization or what that multiple factor should be.
Gotcha. So it sounds like these rules of thumb, I guess you would call them,
Yeah.
can be maybe helpful a little bit, but you got to do the analysis.
That's right.
And so Dan would have to do is, would you agree with that, Dan?
Yes.
Thank you. Okay. Well said. Okay. Good. John, one last question for you, and then my family members might have some questions for you. But you've been practicing law for many years. I was saw that you even served as a judge, so I'm sure you've seen some the best and the worst of it when it comes to.
Seen a few disagreements.
You've seen a few disagreements.
A few.
Okay, yeah. Very good. So I'm wondering if you could give us some parting words of wisdom, like the best piece of advice, maybe a war story if you have one.
Sure. Well, I think the three most important things to avoid those disputes is planning, planning, and planning. And I think having this team together where you routinely get your financial advisor, your CPA, your attorney, your lender, your banker together to review your plan periodically, maybe not every year, but maybe every couple years, to make sure that you're staying current is really smart. I've seen a lot of business owners be penny wise and pound foolish because they don't want to spend a little bit of money to plan, but then once they've transitioned perhaps to the next generation or even to some non-family member owners, disputes arise that can cost many multiples of what it would have cost to plan up front. I've got a few war stories, but I'll just tell one quick one about a shareholder agreement that didn't have a valuation, didn't provide for a business valuation. It provided for an agreed certificate of value where the shareholders got together over a cup of coffee every few years and just said, hey, what do we think the value is? And that worked great when 80% of the company was controlled by the founders and they had a 40-year history together and everything was great. Well, over time, they didn't plan and they had sold off 5% here and 10% there to minority shareholders, some family members, some not. But they hadn't updated the shareholder agreement to update the valuation methodology. And actually, the wording was a little bit ambiguous on whether those minority shares should be discounted or not, or whether the difference between fair market value and fair value, which has been the subject of a lot of court decisions over the years. So lo and behold, the 51% owner is in his office one day, and four minority shareholders all walk in at the same time. And the other thing the shareholder agreement didn't do is limit the number of, or the percentage of ownership that could walk out the door at the same time and required to be bought out over 5 years. So, resignations land on his desk and demands to be bought out. 45% of the company demanded to be bought out over 5 years, which caused a significant, yeah, exactly, you're shaking your head, I know. And that in turn led to some uncomfortable conversations with the company's lender too, because it caused a significant impairment of the company's financial condition, having to buy out those shareholders over a very short period of time. So planning avoids a lot of those very expensive and very uncomfortable conversations on the back end.
That's a great point. I looked at our buy-sell agreement and it said determine at book value. And so clearly I've learned that that's probably not right. So at a minimum, I need to update that. Well, good. So I think I got a few good takeaways from this. And the first is that I'm glad I started early in the process. It seems like it's very important to get a team together because you guys each bring such different perspectives. And then third, it seems like discussion, just starting the dialogue is so important because each one of these interviews we had so many different options that we could have went in, and unless if you have a really good understanding of what the seller and buyers are looking for and what's going to work for the family business, there's just so many different routes that you could go. So really stresses the importance of having a good team. So I'm going to reach out to my family and see if anybody has. This will be the question and answer part of the presentation. If anybody has anything questions for our panel. Hopefully we can have a little discussion here. Come on, answer some questions. All right, there's my crazy uncle in the back there. Yeah.
Crazy Uncle Brian. Actually, I'm the crazy son. You know, Dad wants me, he's talking to me about selling me the real estate, and he didn't really have good environmental practices when he started it. So I don't know if I want to inherit his liabilities.
You know, Uncle Brian, what you might think about doing is crazy Uncle Brian. You might think about hiring an environmental consultant to perhaps, get an assessment of the real estate before you agree to have Dad do that.
We're going to need a bigger stage. No, that's important. When you talk about the asset versus equity sale that we talked about earlier, when you're buying equity, you're buying risk. You're buying anything, any potential lawsuits coming down, you're buying all of that. So if you're in a situation like that, you may, it'll work a little different with real estate, but you might be looking more of an asset sale. Maybe you don't trust your family so much. All right, anybody else? Oh, there's our talented Aunt Betty. I don't know.
So as a second generation coming into this, and not first generation created it, not being given much information as to what their plans are, how do you start that conversation? Because they've been very resistant at giving any information whatsoever. So it's like, where do you even begin that to start to know how to transition into all of this?
Yeah, that's the hardest thing. Starting the discussion, and perhaps it's really framing it like it's exploratory, that nothing is going to happen. We're not going to do anything this year. It's just trying to understand things. Also, I've seen in practice that converting small stock ownership is a good opportunity to get somebody involved, see whether or not they're comfortable being a business owner. It shows the seller that everything's going to be fine, and so doing small increments can sometimes be a good thing to do. But I also think you can reach out to the advisors of the company and kind of express that in perhaps your advisors, because oftentimes we're trying to tell the seller the same thing, right? We're trying to tell them, hey, judging by the amount of gray you got, when things are, you gotta move this along. So we're probably fighting the same front. And so you expressing that's happened. I've had, family members, children come up and say, hey, can you bring this topic up the next time we're all together? Right. Oh, there's that alpaca farmer over there. Yes.
How long did the planning process typically take? I know it's dependent on the business side, not a variable, but are you talking years, 6 months?
What do you guys think?
Yeah, I can sort of echo John's comments on the last question as well. That just a follow up to that, same scenarios where second generation is asking, when is mom and dad going to think about it? So it's a odd circumstance to be put in, but they're clearly not talking. So they're sort of in their own lanes, doing their own thing. And so then I would approach it and ask the first generation, what are your thoughts? What are you thinking? And so you can see it's a lot of back and forth, in every circumstance is different. And it could be years of discussion and planning and sort of putting together ideas of what the goals are and sort of notching off little pieces along the way.
Let's say the next generation, first generation is ready to pass the torch. They're ready to start planning. So how long do you think that would take the planning process?
I mean, it can be short if the seller clearly knows what they want. Sometimes that's the hardest part. Is what do you want? But if the seller has a good idea and you can work with the seller to understand what it is they want, what it is they need, then the professionals can come in and we can back it up. We can figure out what needs to take place, who needs to do what, who needs to sign what, how the bank can get involved. John can draft the documents and so forth. So that part does not have to take. It's getting everyone to their conclusion of what they need. Because once you know what the seller really wants, then the buyer, I mean, it's either going to be the buyer, nope, can't do it, you know. I mean, you see a price tag on something, nope, not going to buy it, you know, or yes, I want to, and then you turn to the professional team to step up and, okay, guys, make this work for me. Put together a structure, Todd, that I will be able to afford, you know, and protect me legally, John, in case things go wrong. So,
if I can kind of chime in, I go back to Dan's comment. It depends, because there's no cookie cutter answer to the length of time it takes. All I could say is the earlier the better. And kind of going back to the last question, I think, you know, my own family, not me, but a family member who was considering buying into a family business, and fortunately the conversation started really early, almost like it was an expectation that, you know, someday you're going to take this over. And the family member in my generation realized after working in the business for a while, I'm not going to be able to pay Dad what he wants. And he felt bad. He felt guilty. They had to talk it out, and ultimately, you know, the dad found somebody who was willing to pay him, and it all worked out fine. But they had to kind of like break through that, you know, just actually sit down and have the conversation. Like, the second generation started getting access to financial information and operational information, really understand the economics of the company, and then realized, you know, he has worked hard, and he's got this vision of where he wants it to go. And I'm not sure I necessarily agree with that. I love him. We get along great, but his vision's different than mine. And I don't think, you know, I'm afraid I'm setting myself up to fail if, you know, I agree to pay him what he wants. And so, I mean, that's the hardest thing, is just putting that out there and saying, this might not work out the way you've thought it was going to, Dad, for all this time. And so, you know, just starting it early and getting the second generation to really understand the business and be open about it and talk honestly about what everybody's objectives are. Now, and it had a happy ending. They found a buyer who was willing to, and, you know, the business is still thriving, and everybody still gets along great, and Thanksgiving was wonderful. So, you know, instead of, being a less comfortable dinner table conversation. So the earlier the better, and as much information as you can share between the generations.
Yeah, maybe said it just a little different way. I would say each piece along the way probably takes a couple weeks, right? Evaluation, 4 to 6 weeks, whatever. Get your financing lined up, get the tax calculation done, get the legal documents. And if you were to line all those up, you're talking about a couple months. It just never happens that way. You know, so.
And that's kind of what I was going to share. I think if from a banking perspective, if you're walking into the bank, if you've already engaged or had conversations with a CPA and you've made the determination this is the path we're going, and we're ready to move forward with a market evaluation, you've got somebody maybe that you've talked to on that side, or you're looking for some input with regards to the bank piece of it. The deal itself, as I mentioned, everyone's got its own characteristics. If there's real estate involved, we might now also need not only a market or a business evaluation, but also need an appraisal of the real estate. Those each probably take right around 30 days or so. That's assuming that we've got immediate access to those individuals that are going to be performing those things. That isn't always the case. If we've got to do SBA, the SBA is going to elongate the process a little bit. I would say generally, if the more prepared you are on those steps, you're probably looking from a banking perspective roughly right around 60 days. The other piece that I mentioned too is coming in also prepared to talk about what that management team looks like moving forward. The further you are with that, to sit down and say, here's what our company is going to look like moving forward, especially in family business where maybe, you know, all the decision making was with John at one point in time, but now we've got to figure out, well, it's going to be 3, okay, but there's got to be a decision maker somewhere embedded within those 3 individuals. all of those things are going to be critical. And again, the more prepared you come to the table with that information, the quicker the process.
Yeah, I agree, and I think that's important to understand too for the seller, the holder of the securities, is to understand that there's outside things that might require it to speed up. For example, with changes to the estate tax exemption or rising interest rates. I mean, there might be some outside things that really behoove the seller to actually speed up the process. And one of those things is the kind of the overall change in employment and just the way the world works nowadays is the buyers, the ones that are sitting in the wings, they're not as patient as they used to be. You know, things are moving too fast. People are being advised that you need to, you know, go to 8 different jobs before you find the one that's right for you. People are not sitting still. So if you're a seller and you're holding on to it too much because you just don't want to let go, you never know. You might look back and then, you know, your succession planning is not there because they've had no choice but to move on. You've left them no choice. So I think you really have to start that conversation early. Make sure that they feel that they are really a part of the succession plan. Make sure everybody on your team knows it too, so they can advise you. For example, interest rates are going up. Todd calls, hey, you know, I knew you were going to try to transfer some ownership, you know. We have that gifting program set up where you're given a little bit of every year, you know. Now would be a good time to do that. So, time for another question? Who's the other hand up there? We got 3 up, so we'll go. I think that's kind of goes along with my comment there on why things are speeding up too. Because if the person who's going to succeed and buy and get those shares feels like they're not getting information and the process is dragging along too much, then imagine how the spouse feels. So I think it's important for them to also be part of the process and to sit down. So in this situation, it would probably be sitting down with Mike to understand how this is all going to work, because it's going to affect the joint tax return. It's going to joint the weekly budget, you know, as far as how much is going to be going out to pay the stock. So I think it's really important that the spouses are involved in that process right from the beginning and have the same level of communication.
Yeah, you know, I think 100% as part of that process would be interviewing multiple investment bankers. They're the ones that are going to go out, they're going to market your business to an outside party. And in a niche industry market, finding someone that specializes in that is critical. That's really a lot of times their differentiator, is that they say, we've sold businesses that are similar to yours for whatever reason. Maybe it's in the same space, maybe it's not, but it has similar characteristics. That can be huge differentiators in that world, because they're going to know how to effectively market your business.
And typically when you sign up for something like that, there's it's a contract, kind of like a house listing, right? And so some are more restrictive than others. Some might be a 1-year, 2-year deal where you if you sell it, you're selling it with them. And in those situations, I've had experiences where all of a sudden the company is not so involved because they know they got you for two years. There's others I know that are more month to month, you know, and you know they're going to be working with you. So I think you need to make sure that you have a good idea of what the agreement is before you sign anything. So the question is what should business owners be doing to increase the value of the business when they're selling to like an outside to a third party?
Yeah, so it depends on who that third-party buyer is, right? So if you've got a strategic that's already in the industry that wants your intellectual property, right? So the development of that intellectual property is key. They're probably going to be less concerned with customers and workforce and things like that. They might just want your software, whatever you might have developed. When you've got manufacturing, business services, anything like that, really having the ability to quickly address any of those buyers' concerns, questions. So that's clean financial reporting, that's clean operations, that's being able to really articulate what separates your business from the rest of your competitors and put together that compelling sales story. I mentioned before that, a lot of times value comes down to the amount and the timing and the risk of cash flow. So being able to really operate efficiently is key, and showing a buyer that you've already made those investments in your operational processes and financial reporting and IT and all of those different areas. Some are dollar investments, right, that you say, well, we got to switch from QuickBooks to a new ERP system or something like that. And some are time investments, right? Like, how's your sales force and your management team and all of that been diversified to get away from that key person risk? And how are you entrenched with your customers? How do you show them the value that you bring beyond the point of sale? Like that's sort of really the shift that we've seen, is understanding the value proposition to the customer base. How are you mitigating risks on the supply side?
Very good. And look at that, 9:25. That's what time it is, and that's that. So we've stayed on schedule here. So I'd like to again thank Regina and your team for hosting this, and my fellow panelists. Hopefully this was helpful to you guys. We'll stick around for a few minutes afterwards if you have any questions. But it was great. We really appreciate the opportunity. Great job. Awesome. Good job. Thank you.
So, yeah, thank you so much, John, Todd, Mike, Dan, and Jonathan, for the wealth of information that you've shared with us today. And I, as an English major, especially want to thank you for making the subject a bit entertaining, as well as very informative and relevant. I'd like to mention that for those of you who may have additional questions, the panelists are more than happy to talk with you one-on-one after we conclude this morning. So please feel free to connect with them before you leave this morning. Also, please note that there is a resource table over by the far wall, and there are lots of really great printed materials provided by many of our sponsor firms that provide more information about business valuation and succession planning and other topics that are unique to family business enterprises. As we're wrapping up, please fill out the feedback form that is on your tables. It's a yellow sheet of paper. This information is extremely valuable to us as we're planning future events. And of course, let us know the topics that you're interested in. We want to make sure that we're addressing the family business topics and issues that are a priority with you. And by the way, with a question that was raised this morning, I put on my potential topic lists maybe a program about having the difficult conversations. Yeah, I see head nodding. Look for that perhaps down the road, not too far. While you're filling out your feedback form, I'd like to mention that the next major event of the Stevens Center will be our annual member dinner. And that takes place on Thursday, February 16, 2023, and it will be right here on campus at SVSU. Mark your calendar. This year will be extra special because we will have 3 iconic Great Lakes Bay region-based inventors, entrepreneurs, and family business founders who will tell the fascinating stories of launching their highly successful family businesses. We'll get a peek into the creative minds of Terry Duperrin of Duperrin Corp., John Hall, Glass Tender, and Al Teamy, Amigo Mobility, and what motivated them to defy the odds and make their own way in the world through their own ingenuity. So please mark your calendar and plan to attend that event in February. As we're closing, of course, I want to thank everyone who contributed to the planning and preparations for today's event. That, of course, includes the small but mighty Stevens Center for Family Business team, Casey, Andrea, Ethan, and John, so much appreciate your acknowledgement of the team. And right back at you, John. You know, I've been with the Stevens Center now going on years, and one of the deep, deep pleasures is to work with the family business owners and leaders, the wonderful representatives from our sponsor firms. Everybody just seems really invested and dedicated to not only making the center a success, but to living the mission of the center, which is to contribute to the success of the family businesses in the region. So it's because of you all, the people in the room, the family, as John would say, that really makes this whole thing work. And I personally, as well as the rest of the team, are very grateful for your engagement and all that you give and provide to the Stevens Center and what we're trying to do collectively here. I'd also like to thank the greeters who helped us with hospitality this morning. Nikki Bergeson of Raymond, Trish Hale and Haley Polano of Huntington Bank, and I think Kevin Rogner of Plant Moran might have pitched in as well. Really appreciate your assistance with making people feel welcome and get where they're supposed to be. And last but certainly not least, I want to thank the fine people of the SVSU Conference Center and Dining Services. Their expertise and professionalism is very much appreciated. So as we close, I want to wish everyone a bright and merry holiday season. I think I saw Wayne Bronner come into the room. Wayne, there he is. Wayne, might you have a little message about how many days?
25 days to Christmas.
All right. Okay, just a reminder, from that little Christmas shop down the road, down I-75, then you turn off into a little town called Frankenmuth. But anyway, Wayne and his people are there. I think they'd be happy to serve you. So, happy holidays, and wishing you the dawning of a very bright and prosperous new year, and we'll wish you a very wonderful rest of your day. Thank you for coming.